we can finish it in time. So yesterday we are just finished at how this Basel came into existence in the worldwide thing. BCBS and Bank of International Settlement, they put together with G10 countries. They came forward with this Basel framework and how this Basel 1, 2, and 3 has come forward. Okay. Now, all the three Basel, whatever Basel 1, 2, or 3, when it was initiated, the thing was started that with only one thing which was important for Basel. Basel has got three pillars. Basel framework works under three pillars. So pillar 1, pillar 2, and pillar 3. So whether it is Basel 1, Basel 2, or Basel 3, or Basel 4, all will continue with the same three pillars. So you can see Basel 1, say pillar 1 is a thicker pillar. So it is most important pillar. Second one is little bit, it's a little bit leaner than the second one. And third one is the leanest one. That means pillar 1's importance is much more than pillar 2 and pillar 3. But they are equally important. But pillar 1 has got more guidelines how to manage the risk and how these three types of risks are there. Major risks, which are credit, operational, and market risk. And how the capital will be calculated separately for credit risk, operational risk, and market risk. And the aggregate of all the three will be the total capital requirement of the bank. So that is called minimum capital requirement. So as yesterday I have told you, the minimum capital requirement is at present for India, it is 9% of the risk weight assets. So total risk weight assets has to, basically this risk weight assets, whenever I call this risk weight asset, this risk weight asset is applicable to only credit risk. Because credit portfolio, loan portfolio, we can assign the risk weight to each type of asset created or each type of loan which is created. It is very difficult to assign the risk weight for market risk. Investment portfolio, it is not so possible. And operational risk, it is totally impossible because there is no asset as such where we can give some risk weight. So for operational risk and market risk, the calculation of capital is totally different from credit risk. But major part of our syllabus in CIB or BFM deals with the capital requirement of credit risk. Major part of the thing. Say I can say that 80% of capital requirement or capital charge will be focused on credit risk, and the rest 20% will be on the operational risk and market risk. Okay, so in this way we will go. So there are three risks as defined under Basel framework for which bank has to maintain the capital. Still, as per Basel, worldwide, the percentage requirement is 8% of the risk weight asset. But for India, RBI has taken 1 plus 1 cushion, 1% cushion. They told that no, for us it is 9% minimum. It cannot be 8%. We should fix it at 9%. Okay, so keeping a bit higher is always safer for our country. So that's why 9% application is for India. So that prescribes the minimum capital requirement. So this pillar 1 describes what is credit risk, how to calculate credit risk capital, what are the different types of credit which are used, and how the risk weight are assigned to each type of loan. That is entire detail is there in pillar 1 of credit risk. Operational risk again. Operational risk, which are the operational risk and how to calculate the capital for operational risk. Market risk also same thing. Market risk, which are the investments, how to deal with the investment to keep to calculate the capital. So calculation of capital to maintain this minimum capital is called capital charge. So whenever you see capital charge, the term, that means how the capital to be calculated so that bank can maintain the minimum capital required as under Basel framework. So that is totally covered under Pillar 1. Now Pillar 2, as the heading suggests, it is about the supervisory review process. Each country, each country has got a regulator for our banking and finance. So that regulator is the supervisor. So country central bank or regulatory bank will be the supervisor. So for India, RBI is our supervisor. So supervisor role is that to keep the bank safe, because banks are dealing with public money. So public's faith should be there in the banking system. So supervisor, a RBI supervisor has to ensure that banks do not fail. So they have to obey all the rules and regulation, and specifically for risk management, the Basel recommendations. So supervisor or RBI will be reviewing the minimum capital requirements and risk management process for each and every bank. Because every bank has its own capital strategy. Because for a stronger bank, it will be different. For a weaker bank or a small bank, it will be totally different. Say, when you compare with the SBI with a federal bank or any smaller bank, then their capital maintenance strategy will be totally different. So according to that thing, supervisor or RPI will be reviewing the process from time to time to ensure that all the Basel guidelines are followed by all the banks and they are maintaining the minimum capital which is required under Pillar 1. And if such RBI as a regulator, while reviewing the thing, they find that some bank is failing behind to achieve that minimum capital requirement, then immediately they will be intervene in the process and they will help and guide the bank so that the bank ensures the safety or bank ensures that minimum capital requirement is maintained. So that is the supervisory review process. This is a continuous process by RBI. Third thing is called market discipline. Third pillar of the Basel talks about market discipline. Means what? That means in the financial market, banks are working. So bank has to maintain the discipline as suggested by the regulator while dealing with their transaction and dealing with all the guidelines, rules, and everything what RBI suggests. Okay, so that means what? That discipline, actually, whether they are doing or not, that has to be published by them from time to time. Normally, at least once in a year, while the annual financial statements are made. Say our closing or annual financial year ends in 31st March. So at least 31st March, where the financial statements are published by the bank, at that time, at least once in a year, every bank has to disclose all things which is happening in the bank. So that is called enhanced disclosure. So disclosing the facts to the public. So publishing means you are making aware of the fact which is happening in the bank to the public. Whether good things are happening or bad things are happening in the bank, everything has to be published by the bank. So that public will know. Public will know what is the status or what is happening in the bank. Whether bank is a strong bank maintaining its capital or bank is a little bit weak as far as the capital maintenance is concerned and other things. So all the things should be published as annexure to the financial statement. So that is why it is called enhanced disclosure. So disclosure to the public has been enhanced under this market discipline. So these are the three basic pillars of Basel framework. Okay. Now, We'll discuss everything under pillar 1. So there are 3 risks: credit risk, operational risk, monetary risk. So capital has to be calculated. Now, as per Basel 3, Basel 3, what are these capital? How the bank is maintaining the capital? What are the capital elements? First, we have to understand. And what are the process or approach where the bank are going to calculate the capital, or how this process of capital calculation will start for all the 3 risks. So there is, we know that it started way back in 1988 Basel. So to India it came in 1992. So gradually it has improved. Everything is improving. So when it started, so for all the 3 risks, there are different approaches to start the process of Basel. So every risk has 3 different approach. So this will have 3 approach, this will have 3 approach, and this will have 3 approach. That means 1, 2, 3, 1, 2, 3, 1, 2, 3. All 3 approaches are that. So every bank will start with the lower approach. After compliance fully with this approach, then the regulator will allow to go to the second approach. It's just like passing JIB only allows you to appear for CIB. Then finally, the third approach. So everything is there. Three approaches are there. Now we'll see what are these approach, why these 3 approaches are there. So basically, credit risk has got 3 approaches. First approach is called standardized approach. Second is called internal rating-based foundation approach. Third is internal rating-based advanced. So in India, we have started with this standardized approach, and almost all the bank has complied with this one. So some of the bank have already started this IRB foundation approach, internal rating-based approach. Okay, third is not at all started. So IRB foundation approach has been started by some of the bank. Okay, so why this 1 to 2 to 3? What is the benefit of it? When you go from 1 to 2 or 2 to 3, so the approach becomes a stronger one. Approaches are severe, means your guidelines and rules regulation become severe, so that you have a sound risk management process. Soundest, or the strongest approach. So when you move upwards, you are becoming more stronger in the approach to cover this risk. Okay, and apart from that, that is the first. That is the first characteristic of approach. Kavya, please can you mute your mic, Kavya? And second benefit is that when you go above the approach, when you move on to above, so there are little bit of relaxation about maintenance of capital. Capital maintenance becomes easier when the process becomes stronger. That is the only benefit. So you are making strong the approach, or making strong your bank by following the different approach, 1, 2, 3, like that you go above. But there will be little bit of relaxation on maintenance of capital. So that is the benefit or characteristic of this approach. Similarly, for the market risk, we have started with standardized maturity approach, then standardized duration approach. Third is internal model approach. So basically, these 2 are prevalent now. And out of these 2, standardized duration method is more accurate to calculate the risk and protect the bank in a, say, we can say 99% protection can be done. It is better than maturity method. So duration method is one method which is more important now. Internal models method has not yet started by the Indian banks. Okay. Now, in case of operational risk, also same thing. We started with basic indicator approach. Almost all the banks have already complied with this one. Here also credit, almost all the bank has complied with this approach. Now, most of the banks have already moved into the standardized approach. Advanced measurement approach has not been started in India. So these are the different approach. Just you have to remember these things so that in case some MCQ comes, you can identify which approach belongs to which kind of risk. Okay. Now we'll see what are the requirement. What is the requirement of the capital? So the capital, as far as India is concerned, at present, only Tier 1 and Tier 2 capital is the prescription for India. There is a tier in Basel 3, Tier 3 capital has been also mentioned, but in India it is not applicable. Just for your knowledge sake, the Tier 3 capital only pertains to the market risk. Market risk segment, extra capital has to maintain, that will be Tier 3, which is not applicable for India. So we are not going to discuss that one. We will only concentrate on Tier 1 and Tier 2 capital. Okay, so Tier 1, Tier 2 capital. Again, Tier 1 capital has been divided into two categories under Basel 3. Till Basel 2, it was only Tier 1, Tier 2. Now, Tier 1 has been again subdivided into two categories. The first Tier 1 is called it is called common equity Tier 1 capital. So, Tier 1 capital in the form of common equity capital. So, we can call that CT1, common equity Tier 1 capital. And other than that, the second one is called additional Tier 1. So together, these two called Tier 1 capital. In Basel 2, it was not so. No bifurcation was there. Now, there is a bifurcation has been made, and accordingly, you have to maintain CET1 as 5.5% of the risk weight, and additional Tier 1 is 1.5%. Earlier in Basel 2, total Tier 1 was 7%. So there was no bifurcation that common equity should be kept this much and other things should be there. There is no such thing. Now, in Basel 3, it has been divided. So common equity has to be maintained at 5.5% of the risk weight asset, and additional Tier 1 at 1.5%. So that minimum Tier 1 stays with 7%. Now, Tier 2 capital. Tier 2 capital has to be maintained at 2% of the risk weight, so that our total Tier 1 and Tier 2 capital becomes 9%, which is the minimum capital requirement for the bank. Now, in Basel 3, another thing which has been added, which was not earlier, up to Basel 2, it was not there. That is the sixth one, which is called capital conservation buffer. And this capital conservation buffer should be maintained in the form of common equity. Again, this is the equity capital you have to maintain. Like you are maintaining this 5.5%. So additional 2.5% has to be maintained by all the banks apart from the minimum 9%, so that the total maintenance of the capital becomes 11.5% of the total risk weight assets. Okay, so this is the introduction in the Basel 3. So this is called capital conservation buffer. So it will act as a buffer capital. So that means extra cushion has been added. Okay. Apart from this, another capital is also there in Basel 3, which is called counter cycle conservation capital buffer, CCCB. So this was only CCB, that is a counter cyclical conservation buffer. Another capital which is also been introduced in Basel 3, which is only applicable to very few strong banks which are called systemically important banks. Systemically important bank means they are considered a big banks. So we can say for India, we can identify three banks under this category who are eligible to maintain this extra buffer of CCCB. So we can say SBI, ICICI, and HDFC. These are the three banks which are actually falling in the category of systemically important banks. So worldwide, there are around 50 banks. Total 50 banks around the world who have been advised to maintain, apart from 11.5, another CCCB has to be maintained. And for that CCCB, a range has been given. There is no cap for that. A range has been given. So up to 2.5%, this can be additionally maintained. So apart from 11.5, again 2.5 you add, so it becomes 14% if you are maintaining all the capital. Okay. Sanjulata Sahu, can you mute your mic, please?
Sir, what is it? Sir, what is tier 1 and tier 2? It is a pillar. It is a minimum capital requirement pillar.
Not pillar. Tier 1 is a capital differentiation. Such capital are called tier 1 capital. I'll just explain. So your question is, what is tier 1 and what is tier 2? Okay. Tier 1 capital is also known as going concern capital. Going concern capital. Always remember, questions are coming. Which capital is known as going concern capital? Tier 2 capital is called gone concern capital. Gone concern capital. Or we can call, this is called core capital. This is called supplementary capital. Means the name suggests core and supplementary means this is a stronger capital. This is little bit weaker capital. Why it is called going concern? Going concern capital name is given to this for the fact that such capital are so strong capital, strong type of capital, or it has got the strength which can absorb losses of the bank without triggering bankruptcy. Means losses can be easily absorbed by these things so that bank is not going to face bankruptcy. So going concern capital meaning the capital which can absorb losses without triggering bankruptcy. So please remember these wordings so that if the MCQ comes, you can easily tick this one. What is the characteristic of going concern capital? So you can say going concern capital means that type of capital which can absorb losses without triggering bankruptcy in the bank. Now, what is gone concern capital? Since it is supplementary capital, it is little lesser value than the core capital. So it is that type of capital which actually has value, but it can only absorb losses only at the time of liquidation of the bank. When the liquidation of the bank or closure of the bank is happening, at that time, this capital will be absorbing the entirety. In the sense, for making it easier to you, these capitals have the value, or I can say that this capital, suppose you have subscribed for this capital for 100 rupees. So when you are going to absorb losses or when you are going to redeem this capital, when you are going to compensate this capital to the losses, at that time, the value of the capital will be either equal to or more than 100. Suppose you have subscribed to 100, then definitely there is always a appreciation. There is very less depreciation of this capital. So capital will be appreciating always. So the value will be definitely equal to the amount you have subscribed, or it will be definitely more than that. So that's why it is called a stronger capital having core value. Now this, so we can call it that this is par or more than par value. But gone concern capital are called supplementary capital or subordinate capital, because there is always a depreciation purpose. So if you have subscribed for 100, so there is no guarantee that you will get more than 100. There might be possible that you can arrive at 90 or 80, something like that. So these are not so much stronger capital. So that's why Tier 1 capital is maintained at 7% of the risk weight, Tier 2 maintained at 2%. Okay, so this is what the, I hope you got it, Tier 1, Tier 2. Okay.
Yes, sir.
Gone concern capital. Can you give some examples?
When I will describe the element of capital, then you can easily understand which are Tier 1 and which are Tier 2. Okay, so I will, next slide, I will give you which are the common equity capital, which are the additional Tier 1 capital, and which are the Tier 2 capital. So we can easily distinguish which are going concern capital and which are gone concern capital. Okay. So basically, when the Basel 1, 2, and 3 is coming, so Basel 3, why it has come? Because first is, in Basel 3, the definition of capital has become more strict, or we can say it has become stricter. Definition of capital has stricter, because here we are supposed to maintain equity capital, common equity capital at the rate of 5.5%. Instead of earlier, till Basel 2, it was 2%. Now, common equity capital, CET1 capital has to maintain 5.5%. That means we have to maintain stronger capital at a higher level. Okay, and till, second thing is that till Basel 2, total Tier 1 was around 6%. But now Tier 1 comes to 7%. So 1% increase of the Tier 1 has happened, because Tier 1 is going concern capital or stronger capital. So stronger capital means bank is healthier. And third thing is that we know that CCB, capital conservation buffer, has to maintain additionally 2.5%. So this is the new introduction. Then fourth thing is, which is introduced in Basel 3, is that mandatory leverage ratio has been introduced. Leverage ratio has to be maintained. So leverage ratio in the form of Tier 1 capital has to be maintained. So basically, liquid coverage ratio and net stable fund ratio. These are the two ratios which have been introduced in Basel 2, Basel 3. This is a new. This is new, and this is also new. Then I have told you that CCCB has been introduced within the range of up to 2.5%. This is up to. CCB is 2.5% minimum we have to maintain. But CCCB, it is for the stronger banks up to 2.5% to be maintained for systemically important banks or systemically important financial institutions. They are called SIP or SIFI. CFI or SIP. So this is beyond the 11.5% capital requirement. Okay. So these are the new things which have been made stronger in the Basel 3 framework. Okay. Now we'll go to
Sir, NSFR.
Net stable funding ratio.
Okay, sir.
Means stable fund, how much stable fund are there, that has to be maintained by bank at a prescribed rate. Liquid coverage ratio means what are the liquid assets you have to keep. Minimum liquid coverage ratio, when at the end of the session, I will just give a brief about LCR and NFS. Okay.
Okay.
Now I'll just say what are the elements of common equity Tier 1 capital. So this is CET1. CET1 capital is First is common shares, means all the paid up equity capital are falling under CET1. Then if the bank has issued share premium, taken share premium from the public, which is called stock surplus, then also share premium will be coming to CET1. Now this share premium can be in tier 1 as well as tier 2 also. So tier 1 means both CET1, additional tier 1 and tier 2. Everywhere you will find this stock surplus is there. That means if you have a stock surplus of total say 100 rupees, as per, so what is the requirement? First, you have to qualify to maintain capital. CET1, first you have to qualify 5.5%. Then you have to come to additional tier 1.5%. Then tier 2 capital. Like this, first comply with this, then comply with this, then comply. So while complying with this, suppose while complying 5.5%, out of 100 of share premium, suppose you have used up only 60. So that means 40 is still there with you. So this 40 can be used next in this additional tier 1. After using say 30, still 10 is there. So then the rest amount can be used in the tier 2. So like this, it can be used. But first you have to start with the CET1 only. You cannot start from the below. Okay, so that's why share premium or stock surplus will qualify for all three capitals. Then the statutory reserves, like your SLR. SLR is one form of where you subscribe to instrument. SLR is a statutory reserve. So some of the SLR instruments are also part of common equity capital. Then capital reserves. Capital reserves which are coming from surplus arising out of sale proceeds of assets. Whenever bank is selling some asset, the money which is received by the bank by sale proceeds, they are kept in the capital reserve. If they are not used, they are kept under capital reserve. So capital reserve is also considered as a CET1. And other disclosed free reserves, if any, they will be also part of CET1. Then next one is your P&L account. If the P&L account has got a profit, that is the credit balance, at the end of the previous financial year, whatever the profit you have earned, that is part of your CET1. Last one is a revaluation reserve. Revaluation reserve is what? Bank has its own land and buildings. Suppose your bank owns land and buildings. It might be 100 years old or 50 years old or something. So RBI has given a leeway for the banks that whatever the land and buildings are there with you, some banks might have old building as old as 100 years old. So those buildings in the books, those value of the book value of the value might be 0, but they carry a market value. Market value is still there. Say, suppose somebody's bank's head office is in Bombay, say Nariman Point or say Coffee Parrot. They have bought that building long back, hundreds years back. 100 years back, that building might have cost you say 10 lakh. Now, the value of 10 lakh might have gone to 10,000 crores or 5,000 crores. The value have appreciated like that. That means in the book, it might be 0, but if the bank want to liquidate itself and they can sell this one, they can get a value of 5,000 crore. So RBI has told that this type of revaluation I will allow. But while revaluation, if your market value is 5,000, I will not give you 5,000 crore totally to be accommodated in the CET1. But what is the cap? Cap is that a discount of 55% will be given. That means only 45% of the current market value can be taken into CET1. So this has to be remembered by you. Revaluation reserve is taken at a discount of 55%. Means if the value is 100, only 45 you can take as a CET1 capital. Okay, so this is tier 1 CET1 capital. Now we come to additional tier 1. Additional tier 1 capital contains the instruments like perpetual non-cumulative preference shares. If bank has issued such non-cumulative preference shares which are in the perpetual nature, perpetual is the indefinite period, then they will come under additional tier 1. As I told you, share premium is also applicable here. And banks also issue some types of debt capital instrument. So they are basically, whenever they are perpetual in nature, so they are called PDI. So those perpetual debt instruments will be qualifying for additional tier 1. Apart from this, any other type of instrument, when RBI says that this will be included in additional tier 1, then also bank can include them. So these are the instruments or elements for the tier 1. Okay, so tier 1, CET1 I have told you, and additional tier 1. The total together becomes tier 1 capital. Or they are the capital which are called going concern capital. Going concern capital. Okay, now we'll move to tier 2 capital. Tier 2 capital contains normally general provisions which is made by the bank in the nature of provision on standard assets. So always remember, provision on standard asset only qualify for tier 2. Provision on non-performing asset or NPA are not part of the capital. Any floating provision, any incremental provision against unhedged foreign currency, provision for country exposure. So all these are different types of provision for contingency which is bank is maintaining. But again, there is a cap for this. The total amount of provision for these things are not allowed. So how much it will be allowed? It is allowed up to 1.25% of the total credit risk weight asset. Suppose your credit risk weight, total credit risk weight asset is say 100, then only 1.25 will be taken into consideration under tier 2. So this has to be also remembered by you. In tier 1 capital, I have told you CET1 revaluation reserve has a cap of 55% discount, and general provisions on contingency has a cap of 1.25% of the total credit risk weight asset. In the Macmillan book, in the risk management chapter, it has not been edited. It was earlier 1.25% of the total risk weight asset. Means risk weight asset of all the three risks was given, but in Basel 3 it has been changed. Now remember, it is only for the credit risk weight asset. So you have to find out what is the credit risk weight asset, and 1.25% is the maximum you can take. You cannot go beyond the 1.25% level. Okay. So other than this, debt capital instrument issued by the banks, debt capital instruments which are perpetual in nature, that will come in additional tier 1. Other debt capital instruments which are not perpetual in nature, that will come to this one. Then perpetual cumulative preference share, if still surplus is there, they will come into tier 2. Redeemable non-cumulative preference shares, they will come into tier 2. And redeemable cumulative preference shares, they will also part of tier 2. And share premium, as I told, it will come as all the things. And any other type of instruments which are notified by RBI from time to time, they will be part of tier 2 capital. Okay?
0.6%
So now,
of RWA tied to capital.
Pardon?
Sir, that, second point and general provision. IRB
Second-
IRB approach.
So this is under standard in IRB approach, where the total expected loss is less than total eligible provision. Banks may take the difference as tier 2 capital. Means, suppose your expected loss is, say, you are quoting expected loss is 50. Whereas you have made a provision of 60. Provision made is 60. Expected loss as per the calculation of formula is 50. Then additional 10 rupees the additional. The difference can be taken into Tier 2 capital. That is under IRP approach. Okay, so under standardized approach, this is not available. This second point is not available under standardized approach. So banks following standardized approach, they are not going for this one. But if the bank is following IRB approach, whether it is IRB foundation or IRB advanced approach, in that case, this 10 rupees can be taken into Tier 2 with a cap of again 0.6% of the credit risk weight. Here 1.25 allowed, here only 0.6. That means suppose your 100 rupees your credit risk weight asset, that means how much you can take? Only 100 is there, so you can take how much? 0.6 only. 0.60 you can take. Okay, so this is only for that. So normally, say questions are not coming under this second clause. So I have just written it. You can read that. It is in the book also. But till now, no question has been coming up for that. Whatever the questions are coming, I have explained those things. So now you understand
floating provisions.
Floating provision, see, any type of provision you are making for a certain period for such type of thing where it might be concerning some provision has to be made. So those are called floating provision. So it is made for a very short time. After that, it will be adjusted. So it can pertain to any type of. So why provisions are made? Provisions are made either to save the losses which might happen in future or to offset the foreign currency loss or foreign exchange thing or any kind of hedging you are doing or any kind of market risk you are taking. So at that time, some floating provisions are there. So you need not go into deep into what type of instrument is there. It is not required under your syllabus. Okay.
Sir, share premium is given in all the three categories, sir. So how to take the premium, sir, means how much percentage in it?
I have explained that. Where were you at that time when I was explaining that thing? When I explained the Tier 1, I have explained how share premium comes under all the three. You are not there in the present while I was explaining?
Yes, sir, I was this.
Then I have explained. What I have explained, you tell me. What I have explained. Can anybody say to him, please explain that how I have explained about share premium, how it will be distributed into all the three capital? Suppose you have 100 rupees in your pocket. Today you have 100 rupees in your pocket. Okay. So how you are going to spend it? Whether suppose you are staying alone in a city, 100 rupees in your pocket today. So whether first you want food or you want to pay bus fare or you want to just buy a tea or coffee or cigarette for smoking, how you are going to spend? Which one you want to spend first?
Food, sir.
First, sir, food.
So first, so 100 rupees there. How much food you are spending? Tell me.
30% around 30%.
30%.
Okay. Okay, you spend 50 rupees. Have a good food, no problem. Okay. Now, second, after satisfying your hunger, everything, food, then you can pay for bus fare to go to office. How much bus fare you will spend?
20 rupees.
20, sir, 10.
Okay, 20 rupees. Say 20 rupees, not 20. Still some money is left. How much you pay for tea and coffee or cigarette or anything your habit is there?
20 rupees.
20 rupees. Okay, so still you are left with 10 rupees.
Yes, sir.
Share premium is 100 rupees. CET1 is this one. Additional Tier 1 this one and Tier 2 this one. So as per year, first suppose you say that 50 rupees will be my food expenses. First we qualify this. After spending 50 rupees, you say that still 50 rupees is available. Then I will accommodate what is available in the next one, additional Tier 1. If full is taken, full I will take. If still after taking 20, still 30 is available, then I can opt for the thing. Still after accommodating all the things, still surplus is there. So that will remain. So there is no hard and fast rule to how much will take. But it should be first completed with the CET1. After that, you move to additional tier 1. After that, if surplus is available, you go to tier 2. Is it clear?
Right.
I have explained the same thing, only repeating the same. Okay. Now, we'll discuss about how the credit risk capital charge is calculated, or capital requirement for credit risk will be calculated. Now, it is the most important part, because from here on, we are going to face all the numericals. So, you should be very, very careful here. Focus on it while I am describing everything. So, before this, we start all the thing, I want to write down one formula, which will be the basis for basic formula required for all credit risk capital charge calculation. If you can remember that formula, you can do any of the problem. So that formula is very, very important. So first formula is, you remember, capital equal to we are talking about credit risk only now. Okay. After credit risk is completed, we'll go to operational risk, and finally we'll go to market risk. Now we are talking about credit risk capital charge, basically under the standardized approach. Okay. So we are not discussing IRB. IRB is little bit different. I will tell you while discussing standardized what is different in IRB, but both are almost same. So standardized approach formula is capital for credit risk equal to exposure. Exposure means we are talking about credit, means we are talking about loan and advances. So what is the loan outstanding on the date where you are calculating the capital? So that is called exposure. Outstanding loan amount in the ledger. So X has taken a loan where as on date he owes bank 10 lakh rupees. So 10 lakh is the exposure on this date on account of borrower X to the bank. So this is basically loan amount which is payable by the borrower today. So that is called exposure. Then exposure has to be multiplied with the risk weight which is assigned by RBI. RBI has assigned each type of loan a different risk weight. So according to the exposure, type of exposure, the applicable risk weight will be multiplied. Then it will be multiplied with the capital adequacy ratio. So capital adequacy ratio is normally, this is 9% for our country. If you take into consideration CCB, then it becomes 11.5. So if the question is asking that calculate the capital including CCB, then CAR will be 11.5. When CCB is not mentioned, normally you have to calculate CAR as 9%. Or the question will be given if the CAR of the bank is 9% or 11.5%, calculate the capital. So basically, capital equal to exposure multiplied by risk weight multiplied by CAR. This you have to remember. Loan amount, risk weight, and capital adequacy ratio. So these four parameters are there. So question will be giving you 3 parameters and you will be asked to find the 4th one. Easier to find, there is no problem. Okay.
Yes, sir.
Another.
Yes, sir.
This formula again can be written as a second type thing. This together, exposure when you multiply it by a risk weight, when the loan amount is multiplied by risk weight, this is called a risk weight asset. Because this is asset is multiplied with the risk weight, so we can call it RWA or risk weight asset. So risk weight asset multiplied by CAR is also capital. So you can remember this formula. Either capital is risk-weight asset into capital adequacy ratio, or it is exposure multiplied by risk weight into capital adequacy ratio. Because exposure multiplied by risk weight is called risk weight asset. Asset is multiplied with risk weight, that's why it is called RWA. So always remember, risk weight and risk weight asset are two different things. When your risk weight is multiplied by asset, it becomes risk weight asset. So clear? There is no problem?
No, sir.
What is no? Where you are confusing?
That is what the system just is mentioned.
Where is your confusion? Huh? Who said no?
No problem.
She said no problem or no? I heard no only.
No, sir. No.
No problem. No problem, sir. Understood, sir. Understood, sir.
Okay.
Sir, can you
Okay.
give me an example here, sir?
What example you want?
Actually, this problem for this formula.
See, 100 of example will follow while doing the example, while doing the numericals. You remember this first.
Okay.
I am telling you to cross the road when the green light is there, and now you are trying to cross. First you learn that green light is on, red light you should not cross. That direction I am giving. After you learn that, then you cross the road, right? So you first remember this one, then you will easily follow. When you are doing all the things, easily you can remember. Just remember these two things. These two things are basic and fundamental problems. This can solve all the credit risk questions. Because we will be doing hundreds of numericals for this. So you will understand. While I'm explaining, I will go in explain such a way. You want always in between, you want something. I will explain. If I leave it something, then I will not leave you with any doubt. Okay, so don't jump into the river before deciding what is the depth of this. Okay. So you write it down and remember this one. So question will ask, they will give 3 parameters. If this is asked 3 parameter, fourth one you have to find out. So you can apply this formula. And if these 3 are given, out of these 2 will be given, they will tell you the fourth one, the third one. Basically, capital adequacy ratio is constant, 9%, you know. So there is no problem. So they will not ask about CR. Either they will ask you the capital, or they will ask about risk weight asset, or they will ask about what is the exposure or what is the risk weight. So risk weight again is a fixed thing because RBI has fixed here. So only exposure will change. What is the loan amount that is going to change? So you have to know the risk weight and you know the CR. So according to you, capital is to be calculated. That is the question. Okay. Now we'll go to that. Yeah. Ask me.
Whether we have to remember the risk rate allotted by the Reserve Bank.
Some of the risk weight you have to remember because sometimes those risk weights are not given in the question. Some of the important risk weight you have to remember. If you can remember all, there is no problem. But normally certain risk weights are very common, so they are not given as a clue in the question. So that can be remembered. Otherwise, they will give the risk weight. Okay. That I will discuss further while doing all these things. You will come to know. And now we'll see.
CAR is minimum capital requirement, na?
Capital adequacy. Capital adequacy.
Buffer. It will not include the buffer.
No. Capital adequacy ratio is the 9%.
Is 9%, not included buffer. Okay.
If they will say capital adequacy ratio plus CCB, then you add 2.5%. So if the question says calculate the capital, if the CR is 9%, means you calculate 9%. If the question says that calculate the capital with CR of 9% with CCB, then you have to calculate for 11.5%.
With CCB. Okay, sir.
Okay. And CCCB, they will not ask because it is still not fully applicable to Indian banks. So CCCB of extra thing, they will not ask. But sometimes MCQs comes, what is CCCB? For which it is applicable. So that type of question will come. Okay. Now we'll see that formula, as I told you, capital equal to exposure multiplied by risk weight multiplied by CAR. This is what. Risk weight is assigned by RBI. CAR is constant, RBI is given. So this will not change at all. Only thing, what is this exposure? Basing on the exposure, the capital will be changing. Okay. Now, what are these exposure? Exposure means what type of loans you are giving. So under Basel, all the exposures are divided into 5 major categories because of their different risk characteristics. According to the risk involved in type of loan, those type of exposure are divided into 5 major categories. So what are these categories? Just see. First category is called domestic category, domestic sovereign category, or this is a government category. Means loan given to the government, whether it is central government or state government, by the bank. Bank gives loans to government. So domestic means our own country and sovereigns means the government. So when bank gives to central government or state government loan, that will be called domestic sovereign or government category. Second, bank can give loan to other banks also. Third is bank can give to corporates. Corporate means big firms. Third, bank also give loan to retail portfolios or retail borrowers. Fourth one is any of these 4 things can become NPA. So when it turns to NPA, the exposure will be treated as under NPA only.
So retail borrowers means?
Retail borrower means when you give a loan to an individual for buying a car or a house, they are retail borrowers. Okay. So for your clarification, what will be called a corporate exposure and what will be called a retail exposure? As per Basel III, any exposure or any loan, whether it is a retail loan or thing, any loan which is more than 7.5 crore, loan amount is 7.5 crore, that will be treated under corporate. Any exposure which is less than 7.5 crore, that will be a retail loan. Simplified. Okay, any loan with a maximum of 7 or less than 7.5 crore of exposure, that will be treated under retail. Any loan which is more than 7.5 crore, that is corporate, except this loan given to bank and government. They are treated separately. Apart from this, any loan is there, they will be qualified for corporate loan if the loan amount is more than 7.5 crore. If it is less than 7.5, then it is a retail. Clear? There is no thing.
Even if the loan is...
Yes. Even if a loan is given to farm also, they will be treated for retail portfolio. Why this is done? This is done because of the fact that the risk weight is assigned by RBI according to this type of exposure. Here I told you different risk characteristics. So accordingly, risk weight is assigned to this type of category of loan. Okay.
Sir, if,
so
if it is housing loan of more than 7.5 crore, it will be corporate or not?
It will be a corporate. So who gives a normally housing loan 7.5 crore, whether it is which bank you are from?
Union Bank, sir.
Union Bank is giving more than 5 crore of housing loan?
Yeah, sir. One branch, Karol Bagh branch, I saw 9 crore housing loan got passed.
9 crore? I think that is sanctioned by your board only. It must have sanctioned by the board because there is
by
no...
the higher authorities.
because
Sir,
see, normally normally they will be treated as a commercial loan. They will not be treated as a.
Sir,
they cannot-
otherwise it may be a syndication or a consortium.
So whatever it may be, if the loan amount is more than 755 crore, you take it as a corporate. Why this bifurcation? I tell you, because of assignment of risk weight only, nothing else. Risky, more risky. Next slide, I will tell you why. Then you will understand what is the purpose of classifying those loans into corporate and those loans into retail. Even if the retail is there, they will be classified on corporate. Some corporates will be classified on the retail. Why? Okay, so you will understand that because as per the risk characteristic, risk weight is assigned. This bifurcation is only for the purpose of risk weight assignment, nothing else. Is it clear?
Sir, what is the fifth point in the risk weight, NPA?
Anything becomes NPA, that will be NPA only. Anything which is done NPA, whichever category, all the 4 categories, if it turns NPA, then once it turns NPA, it will be treated as NPA only. It will not stay in its individual category. Is it clear?
Yes, sir.
Yes, na?
Yes, sir. Yes.
In any bank loan, you have given a loan to bank, it turns NPA, bank is closed. So it will be treated under NPA head, not under bank. So if the bank's risk weight was 20%, NPA risk weight is 50%, then risk weight is increased here because NPA is gone. So 20% risk weight means less capital you are carrying. When it becomes 50%, more capital is required. So that is the purpose. Okay. So when the risk weight increases, the amount of capital will increase, na? Because formula was exposure multiplied by risk weight multiplied by CAR. So suppose 100 into 20% into 9%. So risk weight is 20%, 100 rupees your loan, 9% is CAR. So how much you are carrying? You are carrying 1.80 capital. When it is increasing to 150% and 9%, this means how much? You are carrying 4.50. So that is an increase of how much? 2.70 because risk weight has increased. Risk has increased, capital has to be increased. Okay. So we'll discuss that later on. So just for remembering that this is only for the purpose of assignment of risk weight. That's all. And risk weight is required because we have to calculate the capital, not for any sanction purpose or anything. Simply you remember these 5 categories as per the risk weight from lowest to highest risk weight, it will be there. Okay, now one by one, I will describe what is the risk weight for each one. Okay, so first one, domestic sovereigns. So if any fund-based or non-fund-based loan is given to the government, risk weight is 0. Means it is fully secured. When risk weight is 0, how much capital is required?
0.
As per the cap. So
0.
whenever you are giving a loan to government, no capital is required because it carries 0% risk weight. Okay. Now, if central government guarantee, see, it is loan given directly, but some of the loan which are given where central government or state government may give a guarantee against that loan. Means loan has not been given to the government, but government has given guarantee to some other public sector enterprise or something. Say bank has given a loan to a public sector unit. And this loan of 100 rupees is guaranteed by, say, a state government or central government. In this case, it says that if the central government guarantees the loan, it will have 0% risk weight. But when this guarantee is given by the state government, then risk weight becomes more, 20%. That means central government is more safer than the state government because state governments normally depend on the central government finances or they give loan. So that's why If a loan to public sector unit is guaranteed by state government, it will carry 20% of risk weight. If it is guaranteed by central government, it is carry 0%.
Sir, the guaranteed loans can be given to the individual categories also.
Guaranteed, which individual loan will be guaranteed by a state government, you tell me?
Say, for example, sir, sometimes educational loans or such loans are guaranteed by central governments for a certain amount.
No, they are not guaranteed by central government. They are rather guaranteed by a. They are not guaranteed by central government. They are guaranteed by central government agencies like DSCAC, CGTSI, or say credit guarantee, say CRGF.
CGFMU or.
In such cases, here it is that will fall under this category. So they are directly not given by state government. They are given by an agency on behalf of the government, which is created by the government. Basically, those agencies are not wholly owned by state government. State as well as the central government, they hold. CGTMSC, CRGFLTH, DICGC, all the things are central government as well as state government participation is there. So in such cases, if the loans are guaranteed, as you have pointed out, education loan is guaranteed by the government agency, then it will carry 0% risk weight. Only thing is that when anything is guaranteed under ECGC, it will be carrying 20% risk weight. Okay? And this risk weight, all the things as I told you, as long as these are standard loan, this risk weight will carry. Once it turns to NPA, NPA rate of risk weight will carry. That we'll discuss at the end.
So what is investment in state government securities? Please elaborate.
Banks, suppose state government wants money. So debt securities in a debt market, if state government wants to raise money from the market, the state government will issue some kind of bonds, like central government issues bonds, because they want money. Public will invest. So that is called investment in government security. When banks invest such security in the state government, this is also 0%. Central government, definitely it is 0%. Okay.
In case of state government, it is 20%.
Pardon?
In case of state government, it will be 20%.
Where it is written?
Sir, state government guaranteed clients.
So you read these things.
Yes, sir.
State government, see, investment in state government or central government security is always 0%.
Right, sir. Right. Okay, sir.
Okay, so just read this. Other than that, nothing is there. This much is there. Okay. So we have discussed about domestic government. When the loan is given by the bank to the government, what are the risk weight? Okay, you just remember this one. All are 0 except that if it is a guarantee government by state government, then 20%. If it is a ECGC guarantee, it will carry 20%. Other than that, everything is 0%. Okay. Now we'll go to the banks. So claim on banks means if a bank gives a loan to another bank. In such case, first is that if that loan, suppose say a bank, suppose your Union Bank of India. Union Bank of India is a scheduled bank. It gives a loan to say another scheduled bank, like say Federal Bank. Federal Bank is given. So Federal Bank is a scheduled commercial bank, a scheduled bank, which comply with the minimum CRAR prescription of RBI. CRAR and CAR is the same thing. Credit, say capital adequacy ratio or capital to risk adjusted ratio, both are same thing. CAR and CR. That means Federal Bank has complied with that 9% CAR of RBI. If that loan is given by Union Bank of India, so Union Bank of India have to risk weight has to be taken as 20% for Union Bank of India. So Union Bank of India is calculating capital on that loan given to Federal Bank, which has complied with the CAR of RBI and is a scheduled bank. Then risk weight will be 20%. If instead of federal scheduled bank, if it is a non-scheduled bank, then the risk weight increases to 100%. That is a prescription. Again, that might be possible. These two are applicable when they comply with the capital adequacy ratio of 9%. There might be possible that some of the bank loans are given where they have not achieved this capital adequacy ratio. In that case, these risk weights will be applicable as per their capital adequacy ratio. So for scheduled bank, these are the risk weight. For non-scheduled bank, these are the risk weight. So you don't have to remember this, because in the question, if the question is asked about such thing, they will provide this type of table to you. So you can easily look at what type of risk weight will be applicable for that bank. Say X bank has given to Y bank, which is a non-scheduled bank, having a capital adequacy ratio of say 5.2%. So what will be the risk weight? Non-scheduled bank?
100%.
50%.
250%. 250%, sir.
Very good. So it will be 250%. Because it is a non-scheduled bank having 5.2% of CR, means this category, this is within the 3 to 6%. So 250 will be the, so you have to locate, satisfy these conditions and locate which risk weight is applicable. Okay. So who said 100%? That is only when the non-scheduled bank achieves the 9%. Here I told that it is CR is 5.2%. So this will be not applicable. This table will be applicable. So you relate to this table and find out which is the risk weight. Clear? So these are the things for risk weight for banks. Now we'll come to the corporate. For corporate, as I told you, that what is the qualification to become a corporate exposure? What is the minimum qualification?
7.5 crore.
More than equal to or more than 7.5 crore. Okay. So if your exposure is such, then first thing requirement is that you have to do a external credit rating. That is compulsory. External credit rating has to be done. So there are credit rating agencies. There are 8 credit rating agencies are there in India currently on the panel of RBI. And other than that, 4 foreign agencies are also there. So bank can assign this credit rating for that exposure, and they will give that rating. And rating you can relate to, these are the ratings. So ratings given for that corporate can be related to this. So the top one is AAA rated, and lowest one is the unrated. So AAA, AA, A, BBB, BB, and below means after BB, C and D are also there. So and unrated might be also there. So accordingly, you see the best rating are more safe. That's why they carry least of risk weight. And the lowest rating, they carry 100% risk weight. Now you will see that unrated has a assigned 100%. That means it is less than that, because this unrated is applicable for 1 year period only. Means a new loan has been given with a bank where you have given this to an agency for rating, but rating has not come to you. So for a 1 year period, RBI allows you to apply a risk weight of 100% only. So within a period that 1 year, you have to complete that rating and get the rating. If it is not completed within 1 year period, so if you exceed 1 year, then this risk weight becomes 150%. Okay, that much you have to remember. So normally in the questions, they will be providing you the risk weight. But if you can remember 20, 30, 50, 100, 150, then it's fine. If it is not possible, then in the question, normally they provide the rating so that you can calculate. Okay, so corporate is done now. Now we'll move to the retail portfolio. So retail portfolio qualification is what? Less than
7.5 crore.
7.5 crore. That is the first thing. So this earlier it was 5 crore. From October 2020, it has been increased to 7.5 crore. Okay. Now this for retail, there are two things you have to remember. There are some bifurcations. So normally for retail portfolio, like corporate, no rating is required. For corporate, rating is compulsory. Without rating, you cannot have any risk weight, because risk weight is assigned for corporate according to the credit rating given by the external agencies. Now here I will just go back and tell you, here we are discussing about the standardized approach of credit risk, where the rating is assigned to the external credit agency which are under the RBI panel. Okay, so in standardized approach, the rating will be done by external agency. When we move to the IRB approach, internal rating based foundation approach, or internal rating based advance approach, these are the approach number 2 and 3 of credit risk. In that case, as the name suggests, internal rating means you don't have to depend on external rating. The bank can have its own rating procedure if it is capable. They can do the rating themselves without depending on external agencies, because you have to pay a fee for that external agency. So if such cases is applicable, when bank is efficient enough to do the rating, then they can move into internal rating based foundation approach or advanced approach. That is the only difference. All other things remain same.
Okay. There is a rating BBB minus BBB plus. What does that mean, sir?
See, again, there are score like A plus, A minus, like that. So you can bifurcate. These ratings can be also made. So basically A plus, A minus, these are taken into consideration while sanctioning a loan. Sanctioning a loan, you sanction the amount, and this plus or minus are taken into consideration when you decide the rate of interest to be charged. So you take MCLR plus 1 for A plus. You charge more for a minus. So MCLR plus 1.25 or 1.5. So basically A plus or minus is required when you are deciding the price of the loan, not for the risk weight. Okay. So don't confuse with that.
So for IRB approach also same, sir, this one?
All are same, all same. Only difference is that internal rating is applicable. You can do internal rating. In standardized approach, you are depending on external rating agencies appointed or approved by RBI. That is the only difference. All procedures remain same. Okay. Any somebody else asking some other question? Any question is there? Just ask me fast.
So it's like a CIBIL score, Maria, sir.
CIBIL is for different. CIBIL is for deciding whether you are going to give a loan or not. This is about, yes, rating is about credit worthiness of the borrower. So it will tell you how risky is your portfolio or your exposure is. So highest rating means credit worthiness of the borrower is good, so he will pay you back. So CIBIL rating, basically, CIBIL rating is limited to, normally when we give individual loan, we go for CIBIL rating, and also sometimes we also have some corporate rating also, but those are consumer rating, but they are not for bigger loan like more than 5 crore, 10 crore. Normally banks do not depend on the CIBIL score, they depend on the external rating agencies. That is to be done by the borrower from any external agencies. So we will depend, those are better method than the CIBIL method. Okay. Now for retail portfolio. Retail portfolio, as I told you, it is 7.5 crore or less. So here no rating is required, and a flat rate of risk weight is 75% applicable. But there are some exceptions. 75% will be applicable to those except this loans. Except for this type of loans, all the loans in retail category will be applicable at a 75% rate. So what are the exposure? Exceptions are if loan is given to a real estate exposure. When there is a, you are giving a loan to a real estate, or it is a housing loan, or it is a consumer credit, or NBFC, or IPO finance. Consumer credit means your credit card also comes into the picture here. Then if it is a staff loan, or it is a exposure buy of investment in securities of anything, so bond and equities, then capital market exposure or venture capital fund. If these are the loans, then they have got a separate risk weight. Here 75% is not applicable. So I have highlighted this 1, 2, 3, 4 only. So you have to just remember this 1, 2, 3, 4. 5, 6, 7 are not important as far as our syllabus is concerned. Because questions will be asked on normally this type of 4 exposure where there are different risk weight. Now I will show you the risk weight in this table.
Sir, what is real estate?
Real estate means you don't have, when you buy a house, you buy it from whom? When you are buying a flat, you are going for a flat. From whom you are going to buy?
Builder.
Dealer. Builder. So builder is the real estate. Okay. We don't call it builder. This is in the financial term. They are called real estate agents. Real estate. So they can make commercial project or they can make housing project. Commercial project means malls and cinema halls and other things, that is commercial. And when you make flats for residential purpose, that is called housing purpose. So real estates are divided into 2 categories. One is called commercial real estate. So when your loan is given to the commercial real estate, your risk weight is 100%. When the loan is given for a real estate agent who is building houses for residential purpose, in that case it is 75%. Okay, now come to the second one. These are the individual loan given to the retail customer under housing loan. So in housing loan, again, the risk weight is dependent on 2 things. One is your sanction limit. Another is based on the LTV, loan to value ratio. Normally, in case of housing loan to value ratio is calculated. This is the formula of loan to value ratio. Loan to the value of security. Loan amount to the value of security multiplied by 100 becomes the percentage. So LTV is a percentage. So here, according to that, if a housing loan given up to 30 lakh, where the LTV is less than 80%, then risk weight becomes 35%. Same 30 lakh, up to 30 lakh, if LTV is going upward, means more than 80 to 90, then risk weight becomes higher to 50%. Next category is loan is given for a amount of 30 lakh to 75 lakh, more than 30 lakh to 75 lakh, where the LTV is up to 80%, then 35% is risk weight. Above 75 lakh, if the LTV is up to 78%, then it is 50%. Now, suppose I will ask a question here. Suppose a loan is given under this category, 35 to 75 lakh, and the LTV is say 90. What risk weight will be applicable?
50%.
Can anybody else say what will be the risk weight applicable?
35.
We
50%.
cannot give greater than 80% of LTV.
But this is housing loan, I told you, na? Housing loan, a retail loan. Huh?
75%.
Yes, very good.
75, sir.
Who has told 75 is the correct answer. As I told you, if anything which is not falling under this category but is a retail loan, it will have 75% of risk weight. First thing I told you, except for this, all other category will have 75%. So when it is not fitting in this category, so it will have 75%. Similarly, above 75 lakh, suppose LTV is say 80%, 82%, 75%. So whichever not fitting in this, it will have the 75% of the flat rate. Okay.
Okay, sir.
Next one is consumer credit, or even this is credit card also. So for them it is 100% risk weight. If we are giving a loan to a NBFC, it carries 125%. If it is for a IPO finance, for any purpose is for given for IPO finance, it will carry 125%.
Sir,
The
in
next
present scenario, this IPO finance has been stopped now.
IPO finance has been stopped.
Yes. It has been. No IPO financing
To retail investors has been stopped.
Yeah, sir, I think so, sir.
I don't know, but still this is there in the list. RBI has not changed that. If it is stopped by some banks, that might be possible. But some banks were financing earlier to finance the IPO. Suppose I want to buy a share of anybody who is offering. So up to 2 lakh finance can be obtained by me. Somebody's mic is, please, can you stop that? Some TV or something is there. TV, some background. Okay. Next is your staff loans.
Sir, recently LIC's IPO was financed by banks.
That is what I'm telling now.
Yeah.
So IPO finance means financing to the investor to buy LIC shares. That is called retail finance. Okay, IPO finance means suppose I want to buy a share of LIC, I don't have money, so I can go to a bank. Bank can finance me up to a certain amount, say 2 lakh I can buy. So 2 lakh up to 2 lakh bank can finance me. That is possible. Okay. So for LIC, if the bank has finance, means the IPO finance is still there. It has not been stopped. Might be stopped by some of the banks. Yeah, some of the banks might have stopped it. So it is not a general listing. Okay. Now staff loan. Staff loans, normally they are secured by PF or pension. Whatever it may, pension or PF, whatever it be. When they are secured by PF or pension, then risk weight becomes 20%. If they are not secured by PF or pension, but staff has taken a loan, they will carry 78% of risk weight. Okay, now read this one. This is very important. Sometimes what happens, some of the housing loan, due to some problem of something, housing loans are restructured. Restructured means they are on the verge of falling to NPA due to some genuine reason. To save that from NPA, housing loans are restructured on behalf of the customer so that they will be under a category of restructured or a standard category, but they are not falling into NPA. So that means suppose a housing loan was given for a period of 25 years or 20 years. Now that due to some problem, it might be a problem of the borrower or the market, whatever. So he wants that the installment he cannot pay due to some financial problem. So for 20-year period, installment fix was at 25,000. So he is not able to pay. He can pay say 15,000 only. So in that case, bank may consider restructure of housing loan by extending the period, say that we can extend it to 30-year period. So that 25,000 EMI will come down to 15,000. In such case, those loans are classified as restructured loan. For such a restructured housing loan, an additional risk weight will be calculated apart from this one. So please read this one. For restructured housing loan, should be risk weighted with an additional risk weight of 25% to the risk weight prescribed. That means if the risk weight of the housing loan is 50%, suppose risk weight is 50%. According to this, suppose this one we have given. So this 50% is the original risk weight and this loan has been restructured. Now, as per restructure, we have to add 25% of original risk weight of 50. So 50 was there, additional 25% of risk weight will be added. So it becomes 50 plus 12.50. That means 62.50% is the risk weight if that housing loan is restructured one. Clear? This has to be remembered. Some type of questions are asked for this one. Any doubt on this?
No, sir.
No. So somebody asked how to calculate. These are the risk weight which have been assigned by RBI. There is no calculation. RBI has given this. Suppose you are getting salary. You have got a basic salary. You got DA. How you find out DA? DA is given by whom? DA percentage is given by whom? Every quarter your DA changes. So DA is given by whom? Who has asked this question? DA gives who gives you a DA? Mr. Pankaj Tripathi. Pankaj Tripathi, you have asked the question how to calculate our risk weight. I am explaining to you. Who gives the DA rate?
Fixed by employee.
Huh?
Ministry of Labor.
IBA. IBA. Okay. IBA decides the DA according to what?
Inflation.
Inflation. So inflation is given by whom? Inflation is inflation rate is given by whom?
Government.
So basically government. Okay. So from government IBA takes and gives the DA rate. So here from government RBI taken, RBI gives risk weight. Okay. So these are assigned risk weight. You cannot calculate that. It is fixed. So when DA is given as 35% means your basic X into 38% will be your addition to your basic.
So
That
straight line
becomes your
questions
salary.
may be asked from. So some straight line questions may be asked from this table.
What straight line question? What straight line question?
Means the housing loan is 30 lakhs and it is between 80% to 90. What would be the RW?
No. These type of question will be not asked. Only numerical questions will be asked. Such type of question will not. You cannot remember this.
We need to remember this table.
If you remember all things, then you can get 90% in a BFM. If it is better to remember whatever you are studying, if you remember, that is good for you. You will get more score. If you don't remember, there is a risk. But normally there will be certain things are there which are given in the questions. Most of the things are given. Very few risk weight will not be given because those are common. I will let you know while like CAR might not be given. So CAR, now you know what is the CAR. So by doing all the process, by the end of next month, 30 days, when you do all the exercises, numericals, you automatically remember what are the risk weight for what. So you don't worry about that. When you practice, it will be always remembered within your head. Okay. So last one I will describe so that we can complete our thing. So last one is, what is the non-performing assets? What is the risk weight for non-performing asset? So any of the four other things, when they turn to NPA, so risk weight of NPA will be applicable. Just remember, so for any NPA, the risk weight is decided on the specific amount of provision made for that NPA. So when a standard asset turns to NPA, immediately we have to make provision. Provisions are to be made according to the state of NPA. Say substandard, doubtful, and loss asset. Again, there are different percentage of provisions has to be made. So basically, we have to see what is the amount of provision. So when the provision amount is less than 20% of the outstanding amount of NPA, in that case, risk weight will be 150%. If the provision amount is more than 20% but less than 50% of the outstanding amount of NPA, risk weight will be 100%. And if that provision amount is equal to or more than 50% of the outstanding NPA, then risk weight is 50%. That means when the provision is increasing, the risk weight is decreasing. Or when the provision is less, risk weight is more. Okay. For example, suppose 100 rupees loan has turned NPA. Okay. Now here, the provision you have calculated and kept in provision account is say 18 rupees. So in such case, what will be the risk weight?
150%.
150%. Because 18 is less than 20% of the NPA amount. Okay. Suppose the amount is 53, then risk weight will be
50%.
50%.
So equally, you can just see where it is fitting. So you have to, I think it is better to remember. Can you please mute your mic? Somebody's disturbance is coming. So I think it is better to remember these three, 150, 100 and 50. If you can remember, that is fine. Sometimes in the questions, these risk weights are not given. Sometimes. Most of the times they give, otherwise you have to remember. First thing is that NPA less than 20%, 150. Remember the formula. Less provision, more risk weight. More provision, less risk weight. Because already provision amount is there. So less capital is required to cover the risk. That is the logic. So less than 20, 150 risk weight. More than 20, up to 50, 100% risk weight. More than 50, 50% risk. This much, if you can remember.
Full provision has been provided for, then what's the rate of risk weightage?
I can't hear you properly. Can you tell me again? Please come closer to the mic and tell me. I could not hear you.
Hello.
Can you repeat your question, please, clearly?
When the full provision has been provided for, then what's the risk weightage?
Full provision means you are telling 100%.
100%, yes, sir.
So 100% is more than 50% or less than 50%?
It's more than 50%.
So here it is
50%.
There, more than 50% is, that is a category here, na? So equal to or more than 50% means if you are keeping 150% provision means it will fall in here also. If you are keeping 500% provision also, it will come here only. Because it is equal to or more than 50%. Okay?
Okay, right, sir.
Any other question? Otherwise, we'll.
Yes, sir. Sir, in case provision is exact 20%, sir, then
you see,
it is mentioned here less than 20% and more than 20%.
150.
If it is 20%,
150.
Okay. Oh, okay. I will correct it. It is equal to or more than. Yes, I have to correct. That is my mistake.
Right,
my mistake.
sir. It's okay
sorry.
now, sir. Yeah.
Because here equal to is written. Here I have missed that one. Please correct me. Okay. Thank you. Thank you for that. Equal to or more than 20%, but less than 50%. First one is less than 20%. So here you can say equal to or more than 20%, but less than 50%. That I will correct. Today only, after the class, I will correct it. Any other question?
Sir, how many questions are being asked from capital sector?
There is no standard thing applicable. Any question come, it is every year it is different. So you cannot expect that this question will come or this number of numericals will come, this type of MCQ will come. There is no such hard and fast rule. So better be prepared with all your arms and ammunition. When the enemy comes, you shoot them. That is the better. The more you are prepared for the battle, you can win the battle. Less prepared, there is a chance of risk is always there. So do not expect that this type of question will come or this much of numerical will come. Prepare yourself fully. You want to see, this is aim should not be only passing CIP. Aim should be that I will learn something. I will be a better banker. I will serve my bank as a good asset. I should not be an NPA to the bank.
Yes, sir. Yes, sir.
Okay, so if that is the motive, then you can learn anything. You can score more, whatever. So don't afraid of who. See, if a soldier is there fighting for the country, if he sees that whether the other people are coming, whether they are coming in 100 or 5 or 10, or they are coming with elephant or tiger or a tank or something, then I am at totally confusion. I should be ready. Whatever the consequence, I will fight. As per my arms and ammunition government has given, I will fight. Whether I'll die or I will be a hero, that will be decided later. So be ready with everything. It will be done. If you are, see, God will help those who help themselves. If you are helping yourself by preparing yourself, then God's definitely luck factor will add it to you. If you are neglecting your thing, you think that, oh, okay, we'll see. I'm getting salary. What is the purpose of this? That is a different attitude. So in that case, God is not going to help you. Okay, these are my personal views. Any question? Otherwise, we'll stop this.
Sir, you have said about that additional risk weightage in restructured housing loans, na, sir?
Okay.
Does that apply to whatever housing loans has been restructured during this COVID thing and all? It's a general information I'm asking. During COVID, we have restructured many housing loans. So this additional risk weight of 25% has been applied to all those housing loans.
Yes, anything. Sir, RBI has not exempted those specially restructured housing loans during COVID time. They have not given a special exemption. Any housing loan which is restructured due to special cause of this pandemic or whatever it may be, in that case, it will add. See, hardly it is only how much? 25% of the original risk weight has to be added. This is a precaution to the bank. We are saving it. If it is not required, fine. Nah, we are sending our capital only. Only thing is that it burdens that 12 rupees 50 paisa we are deducting from our profit. So that our profit, we are showing a less profit. But by the way, we are protecting ourselves. That we are not going to be face the bankruptcy.
Okay.
Sir, what about the MSME portfolio, sir? Here only retail we are discussing.
Excuse me, sir. Provisioning is always deducted from profit.
Yes, provision,
And
capital.
such capital is also deducted, or it is kept separate?
Your salary is also deducted from the profit or not? Your salary comes from profit or not?
Yes, from profit.
Yes, sir.
So all the operating expenses, provisions, capital, everything comes from the profit. Earn profit and stay in the business. Earn losses, get out of the business. That is the only rule of business.
Okay, means capital and provisioning both are kept separate.
Yes, capital is the first item in the liability side. Capital. You are not allowed to touch. But profit can be touched by you, na?
Okay.
Profit can be, so out of the profit, suppose you have earned 100 rupees profit this year, as per Banking Regulation Act, 20 rupees profit has to be kept in the reserve, in the capital and reserve. So only 80 rupees you can show as profit. Okay, so this profit you can utilize it at any point of time. But capital, when you keep this 20 rupees capital, you add to capital or reserve, you are not allowed to touch this. You cannot utilize this because this is the buffer you are creating to save yourself from the future losses which might lead you to bankruptcy. Okay.
RAROC.
Okay, fine. Now somebody has asked where this MSME will come. I have given you these two portfolios. What MSME or whatever thing comes, whether it is a foreign exposure like a packing credit or MSME or any other thing comes, these two will fall under these two categories, any type of loan.
So 75% is the risk weightage for all those things which are not mentioned. This is housing loan and corporate
Okay, your question about the retail portfolio then. You are talking about retail portfolio means MSME loan, MSME with less than 7.5.
Yes, sir.
Okay, then it is 75%.
Okay.
Okay. So you have to decide, first decide the qualification, whether it is going to corporate or retail. The MSME is falling under retail. Now we see whether this fits into this table. If does not fit into table, then simply it goes to 70%. If it is above 7.5 crore, then what will be
external rating based on external.
Very good. It will be dependent on rating. According to rating, again, AAA 20%, AA 30%, AA 50%, like this it will be there. Okay.
So this housing loan thing will be applicable for mortgage loans also, or mortgage loans will be coming under 75%.
No. See why this classification mortgage loans is given, because internationally mortgage loan means housing loan. They do not call housing loan.
Okay.
Mortgage loan means individual housing loan. In India, we do not use this mortgage loan. Mortgage loan means any businessman who is takes a mortgage loan.
Yes,
but
sir.
here this mortgage loan means individual housing loan only, because it is internationally used term. Mortgage means it is a housing loan only.
Okay, sir.
Okay. So this pertains to housing loan for individual. Forget about this mortgage. Normally housing loan is always house is mortgage. That's why it is called mortgage loan. So other than housing, it is not allowed.
Okay.
In case of staff provisioning is for PF 25%, other 75%. I did not get.
You did not?
Actually, I did not get properly, sir. Actually.
Staff, for staff, which bank you are from?
SBI, sir.
SBI, okay. SBI gives loan to the staff?
Yes, sir.
Okay, so different kinds of loans are given to staff? Yes or no?
Yes, sir.
Staff can avail any housing loan, vehicle loan, your personal loan, whatever loan, marriage loan. So any type of loan which is available for staff, they can get it.
Yes, sir.
So in such cases, when the loan is given, that is a documentation takes place.
Yeah. Yes,
without documentation, any bank will not give. Even for staff also, documentation takes place. In that document, you will find that there is a agreement where you are undertaking that you have taken this loan where your PF or pension is lien to the loan.
Okay.
So in such cases, if the loan has got this assignment undertaking from you where PF or pension is secured, this loan is secured by your PF and pension, in that case, risk weight is 20%. If such loans are there where there is no security of PF or pension is there, if any, because certain banks also give such type. Private banks that do not have this pension concept. They might have a PF concept, but they do not have this security of PF or pension. In such cases, that will be 75%. Now it is clear?
Yes, sir.
Okay.
Thank you, sir.
Sir, hello, sir. Nice session given by you, sir. Thank you so much, sir.
Oh, for that only. Okay, thank you. I thought you were asking a question. Anyway, okay, see you tomorrow. See you tomorrow again. Lot of things are done. So please read this portion if possible, so that it will be easier for you to understand tomorrow. So tomorrow we'll start with a lot of things where this calculation will be coming. Okay, be ready with calculation.